Welcome to MarketHammer.com. As always, nothing in this video constitutes a recommendation to buy or sell any security. Please do contact your financial advisor for any advice pertaining to your own individual circumstances. All right, today we're going to take a deeper dive into the technical analysis of the market. We'll focus on the Dow Jones Industrial Average. Major market averages generally moved back about 1.5% today. Focusing on the Dow Jones Industrial Average, it was holding its own for the most part in this range all the way up until the final hour of the trading day, at which point we saw a pretty significant pullback from 25,300 to just north of 25,000. That is also reflected in the day-to-day movements. If we look at this chart, there was a fairly significant move right below the uptrending support line that we had established yesterday. There was a pullback to that yesterday, just above it. And today we broke through that. So that signifies there is daily weakness. Now, if we expand the chart and take a look further back in time and actually look at a monthly chart, we can see that even though the day-to-day action, the intraday action, the daily action is looking pretty weak, on a monthly basis, there's really not a great deal to be concerned about. One of the things obviously you see during the pullback recently was that there was a break below this major uptrending monthly support line, and yet the close so far has not been to the downside. So that's always a very positive thing, where we start to see no break, or even if there's an intra-month break below a support line, there's no monthly break. And really, these are the key technical levels to pay attention to. The daily ones are important and show us to the granularity, but for the most part we see intraday and daily some of the noise, and if you want to get a good sense of perspective, it's always good to expand the chart backwards in time. In fact, if we look even further towards a yearly chart all the way back to the late 1990s, we can see just how powerful this rally has been since 2009. And you'll note that even during this rally there were intra-month dips at various times below the uptrending support line. We never closed below that line. There were a bunch of dips during volatile periods, which you know well at this point. And what we have seen as well, more significantly, is that there has been a move above the uptrending resistance line that was established back in 2010 and continued all the way through to late 2017. So in fact, what we know is that despite the intraday weakness, there isn't really much cause for concern that this bullish run is over, certainly unless we get a break below this uptrending resistance line that has become new support, as in it was resistance all the way through to 2017. Then there was a breakthrough, and obviously we've continued higher into 2018. So when we look to the movements, we see that there's been a very, very strong movement over prior months, a move of north of 3,000 points in a very short period of time. No surprise to see some pullback and some weakness, going through a consolidation phase, and still the trend remains pretty bullish, certainly on the quarterly and monthly levels. With that said, if we take a look at some analysis of the from Shiller, which is looking at the CAPE index, or cyclically adjusted price earnings ratio, we see that this is where we are right now. We are looking at a CAPE north of 30, and historically over about 147 years, the 10-year forward returns at this point in time do not exceed even half of 1%. So that is sobering news for the bulls, that over almost a century and a half of data suggests that there is reason to be concerned on a long-term horizon. If we take a look at what the options are, well, where do you go if you're not terribly confident about the long-term horizons for stocks? Well, you could potentially look to bonds. And the problem with bonds right now is that if we look at the option-adjusted yield spread for junk bonds, and actually if we just look at the corporate bond ETF, HYG, it's below the average, below the median, and that suggests that even though the headline rate might be just north of 5%, In practice, when you start factoring in a loss-adjusted spread, which is essentially saying that about a couple of percent, just north of 2% per year on average, you'll see some losses on those bonds, plus the option-adjusted spread, we end up down right around the 3% level. So it's not a particularly good yield. And so this is why the other day, if you were looking at yesterday's video, we were talking about Buffett holding cash. Why is he holding cash? Why is he sitting on $116 billion and not buying? Well, his answer was that while he can certainly find good management teams, he can find good companies, he's not finding them at a fair price. And this is often the case where we're seeing the forward-looking opportunity for stocks to be low. We're seeing that the yields in the bonds aren't especially attractive, and hence sitting on cash is not the worst idea in the world, because at least you can get a return of cash rather than a return on cash, which is what we're typically conditioned to look for. In such situations, our preference is generally to look to options as a means of taking advantage of that. Means that if you're, for example, holding a $100 stock and you've got a collar trade, you can buy put options near the money. Stock drops to 50, you've got put options that you're riding all the way down. You can capture that gain on the puts. You can effectively lower your cost basis through gains on the long puts, the short calls, and you can ride down the bearish trend if it does occur. If it doesn't, you're conditionally structured to be bullish in that collar trade. Now, if we move on to the currency market, the euro, we have seen some gains over the past year. A few questions came in just on how bullish the euro is, so we wanted to take a moment to address that. Certainly over the past year, it's been looking fantastic. There's no reason to suggest, in fact, that there's a technical trend that is anything other than bullish. With that said, there's a very major bearish resistance line that lies just up above the current level. And so if we were looking at a risk to reward ratio, the reward is pretty limited to the upside unless there's a pretty major break above that resistance line. However, when we look to the downside, there's considerably more risk to the downside. So if you are playing the euro or the FXC or the Forex markets in any respect, that is a resistance line to be well respected. And keep in mind that while the shorter term trend, and shorter term in this case being the yearly trend, is positive, the multi-year trend suggests that there is limited upside. That said, have a wonderful evening, folks. Take good care.